There we go. um, when we're new, there's a lot of information coming at us. We're trying to learn a new script, a new sales pitch. We're trying to learn underwriting. We're trying to learn how to place clients with carriers. We're hearing about annuities and advanced markets and final expense and whole life. And it's confusing. There's a lot going on. And then we get on the phone with a client, and it is a real time, real life person that's asking us questions that we probably don't know the answers to. And we're just trying to confidently work our way through it. We're trying to set appointments for senior closers to come on and help us. There's a lot happening. And so, in the effort of keeping things simple when we're new, we do things like, we can either cover the mortgage payment for a period of time or we can pay the home off. And we cover the mortgage payment for 12 months, 18 months, 24 months, whatever it is, so that your loved ones have time to figure out what to do with the home. And more often than not, that's what we're doing for clients that are inquiring about mortgage protection, because that's what's available to us, and that's simple and that's good. And so that's kind of the starting point. So if we're new and you've closed less than, I don't know, 20 deals, that's probably what you should be selling, and you should be keeping it simple. If you're calling aged, you're focusing on policy replacements. If you're doing wingman, you're focused on qualifying the clients. You're not getting charged 30 whatever
No,
dollars.
we're just sourcing.
There we go. So that way we're not getting charged a bunch of money for somebody who was a waste of time. I specifically call mortgage protection leads either fresh, well, all fresh digital. And so that's the majority of what I'm going to speak on. So if you're calling aged or you're calling wingmans or receiving wingmans, this is a little different. Those are different products. For the mortgage protection, the core motivation of that client is that they want to care, they want to make sure their family's okay. They want to make sure the bank is protected from the home, that the family's going to be able to keep the home. And so we start with this, well, let's protect the home and the family from the bank. Right? We go through the three different types of insurance, and this is the only one that protects the home from the bank. And we will continue, we'll go through the conversation, build rapport, and hopefully really uncover like what their core driver is, their why. As we do that, there's a number of other things to pick up on that are additional tools in your tool belt. And so while the mortgage protection, paying for the mortgage, is more often than not what we're going to sell, I want to introduce a third concept to you. Right now we either pay for the mortgage for a period of time or we pay off the mortgage, and that's it. The third concept is paying down the mortgage. And paying down the mortgage is extremely useful when you have either pretty useful in every scenario except if there's like an adult dependent or an adult with a disability. The concept of paying down the mortgage is, instead of paying the whole thing off, we can pay, this program will cover a portion of the mortgage so that your loved ones can refinance, which they're going to need to refinance anyway, because they'll need to get the loan in their name. At some point, the bank is going to say, we no longer have a borrower that we can hold accountable. We need to have a new borrower on the loan. They will call the note due, and the family will have to put the loan in their name anyway. Uh, so some things to keep in mind, right? A $50,000 mortgage at 6% on a 30-year fix is about 250 bucks a month. Which also means a $100,000 mortgage, 30-year fix at 6%, is only 500 bucks a month. So when we have a client that wants to make sure the home stays in the family, they care about their legacy, but their mortgage is like 250,000 and there's no way you're getting coverage for that, we can look at things that maybe pay out 50,000 or 100,000 that they can't afford, because the entire focus is we want to take a position. Once we've gotten to know the client, we want to take a position and present a solution that we know that they can afford and that also meets their objectives. A large part of this is reframing the client's objective into something that is achievable. Okay, so as you get further along in this industry, you'll start to pick up on patterns that you'll see that, yeah, after 70 years old, getting $100,000 in coverage is going to be really expensive. Most can't afford that, and most don't need to. And so what we really want to do is, when we're talking with the client, figure out how we can reframe their objective so it's something achievable, and it sounds something like this. We'll say, Okay, Travis, I totally understand that you want to pay the house off. Tell me why you want to pay the house off. And more often than not, you'll get a client that says, "Well, I just want to pay it off." And so I totally understand that, and we're going to figure that out. I just want to understand why, because sometimes there's ways that we can do that and make sure the family has the protection that they need while keeping it as budget and cost efficient as possible. And I'm sure you want something that's cost efficient, right? You don't want to pay more than you have to. Lily, well, yeah. Yeah, perfect. That's why I'm asking that question. So tell me a little more about why you want to pay the house off. And you can go through the five whys where we're going to ask them why in basically five successions. And the intention is that we can get down to their driving motivation. More often than not, it is I just want to make sure the family's okay. I want to make sure that the home stays in the family. And so if we can get them to see that is truly their goal, now we have the door open to introduce other concepts to them for how they can accomplish that without actually paying off the entire home. So I'll usually tell clients, so yeah, hey Travis, these programs work in one of three ways. They either pay off the mortgage, which is what almost everyone wants, but hardly anyone ever does after we have our conversation. It can also pay down the mortgage and it can pay for the mortgage. It can cover it for a period of time to make sure that your family has time to transition. Now, we're going to look at all of these different options. My job is to serve as your advisor to help identify which one's going to be the best fit for you and your family while making sure we get you the protection that you want for your family, but we also keep the budget at a place that's more than comfortably affordable. How's that sound? And most clients say, yeah, that sounds great. So we know about pay it for, we know about pay off. The pay down is, I think, a secret weapon I haven't heard a lot of people give trainings on, and it's something that I find to be very effective. For that exact example, that we have somebody that wants their kids to be able to stay in the home, they want their spouse to be able to stay there, but they can't afford a $200,000 policy. So we need to reframe it in a way that allows the client's family it allows us to accomplish the objective while delivering a policy that is obtainable and affordable by the client. So in the back of our head, if we know that 50,000 is $250 mortgage payment and 100,000 is a $500 mortgage payment, we could simply ask the client, so hey, let me just ask, now I know we want to pay the home off, but if the mortgage payment was only $500 plus taxes and interest, is that something that your spouse could afford comfortably? And if they say yes, okay, great, we don't have to pay the house off, we just got to get the mortgage down to 100,000, right? So we can reduce the amount of coverage that we have to do in order to meet their objective. And a lot of times that's more obtainable than it is to just pay the entire thing off. I've had this happen in dozens of conversations because how I'm thinking about every sales, I'm looking for what is the lowest coverage way to accomplish their objective while also making sure that I'm driving a premium that's somewhere between $200 and $400. That's typically what I'm looking for. So this concept of paying down the mortgage, yeah, the family's going to have to refinance anyway. The spouse would have to refinance. This is a way that she can receive this money, or they can receive this money. They can apply it towards the home loan, and then they can refinance it. And a $100,000 mortgage at 6% is only $500 a month, or a $50,000 mortgage at 6% is only $250 a month. They can afford that, right? Yeah. Okay. So this is a more cost-effective way to do it. Now, does that make sense for you and your family? More often than not, people are excited to save money. And as long as they can accomplish that objective of making sure their family is safe, secure, and protected, they're pretty, in my experience, um, they often will go for that more so than the pay off. Is that making sense to you guys? Has anybody done the pay down conversation, or has anybody tried that instead of paying it off? Tony, how did it go for you?
It went all the way through the presentation. And then it was both the husband and wife. They just kind of it's this weird spot of, well, if we don't qualify for it and we can't pay it all off, oh well. You know, is like kind of what they ended up with, you know.
Okay, so is it okay if we use this as an example?
Hmm.
Okay.
Yeah.
So how many of you guys also get this? If we can't pay it off, we don't even want it. How many of you come across that? So let's dive in on how you handle that because it's a very real thing. That's obviously an emotional response, not a logical response, right? An emotional response is, well, if I can't get it, I don't want anything at all. If I can't have all the protection I want nothing. That's emotion. And so we have to dig into the layers of like, it's again why I said a little earlier, one of the most important things you can do in a client conversation is get them to clarify their why, and not even just on why they want the coverage, not even on digging into like, well, what would the spouse's plan be and all those things. But when somebody says, I want to pay the house off, okay, tell me why. Why is that? Why the whole house? Like, why the mortgage? Well, I just want to pay it off. Yeah, no, I know. I completely appreciate that. The reason I'm asking is I'm sure that you don't want to pay more than you have to. My job is to make sure that we have the most cost efficient plan possible. And so that's why I'm asking, like, why do we need to have it paid off instead of anything else? Like, why is the payoff important to you? Well, I just don't want her to have to worry about it. Okay, and what does that mean when you say that you don't want her to have to worry about it? What do you mean by that? Like, you don't want her to have to worry about a mortgage payment, or you don't want her to have to worry about the finances? So you can ask these kind of why questions to really clarify what their core motivation is. Because what's happening, Tony, is the client associates paying the entire mortgage off with whatever their core motivation is. And so therefore, if they can't pay it off, that means they can't accomplish their core motivation. So I don't want to do it at all because this isn't doing what I need it to do. And our job is to communicate to them that there are other things that they can do that will still accomplish their core motivation. But if we don't make that, bridge that gap, then they won't connect it themselves either. And so when we are asking, okay, great, tell me why you want to pay it off, what we're really trying to do is we're trying to get on the same page with the client, and we're trying to isolate what that motivation is, and then we can zero in on that. Because paying off the mortgage just isn't possible for most people. So if we leave that motivation on the table, we're setting ourselves up with a bar that's going to be very hard to achieve. So the second that somebody says, well, I want to pay the mortgage off, we have to go further. We have to dig into that and say, okay, why, and get to the reason. So that way we have an open door to reposition the solution that gets at the core reason when we know that paying off the entire mortgage is going to be difficult 90% of the time, if even possible. Does that make sense? Is that something that you did with that client?
Yeah, just like once we got to that point, you kind of realized that they were just shopping, because once we got in there, you could tell it was just they were just shopping for they wanted quotes by that point because you know
Yeah. And the timing of when you do this in the conversation is also very important. So doing this at the beginning of the conversation clarifies their objectives. Doing it at the end of the conversation when you're presenting sounds like a sales pitch. It sounds like, well, I know you wanted this model and we don't have that, but look at this one. This one's really great too. And they're going to say, no, 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 I'm good. I want that model. I'm going to go find somebody that can give me that model for what I can do. I think it's out there. Like, a lot of people think that shopping for insurance is like buying a truck. There's like 1,000 different dealerships and everybody's got a different price. And so the more like the psychological structure of the call, right? At the front end of the call, our goal is we want to identify, isolate, and confirm their core motivation, right? And then we also want to surface potential objections throughout the conversation, right? So on most calls, I'll tell the client, hey, yeah, my job is there's like 40 different A-rated carriers. We don't want to go with a B-rated carrier because that means that they may not be around when your family needs it. So we really only focus on the A-rated ones. And then out of those A-rated ones, some of them are really good at paying claims within 3 to 5 business days. Some of them it's 30 to 60. Now, obviously, your family is going to need this money immediately. So the carriers that pay in 30 to 60, we'll keep those on the back burner. We're going to focus on the ones that can pay in 3 to 5 days. Now, the reason I mentioned that is because, there's really only 40 A-rated carriers. I mean, this isn't like shopping for a truck where there's 10,000 dealerships and you can just go check each one and everybody's got a different price. There's only 40 carriers. and the rates are the rates, which makes my job a little easier, but I just want you to be aware of that. Does that make sense? So at the front end of the conversation, like I'm laying foundation to get those objections out of the way and to reorient the client's thought process in terms of something that's going to be beneficial to me. Does that make sense? If you do that stuff at the end, then it sounds like now it sounds like objection rebuttals. It sounds like I'm trying to reposition something to make a sale, not like whereas if it's at the front, it's I'm knowledgeable and I'm seeking to understand my client. At the end, it's I'm a sales guy that's trying to get a sale done.
Yeah, this one specifically was like because I started in the beginning the way that you were saying it's like, hey, it's kind of like what you qualified for. You said you got rejected from Fidelity, so these numbers are kind of they're set. All of the insurances share medical information, so whatever the medical information that triggers an underwriting that got you guys denied, it's still going to trigger an underwriting again. It's like, how do we explain it best we can to get you the coverage that you want? Then they said, okay, like let's move forward, and then you get through the presentation, and that's when that's this one specifically just happened to be like, you know, like, oh, we can't pay it all off. It's like, well, you never went in knowing you were going to pay it all off, you know?
Yeah, well, and so that is managing client expectations, right? So when you're saying, okay, well, we got declined from Fidelity, so something's showing up. A lot of times I also will you'll get a client that's like, oh, well, I got declined, like you can't do anything for me. And so one of the talk tracks that I use on virtually every call is like, hey, every carrier is different. Every one of them has a niche. Some are good with cancer, some good with diabetes, some are good with heart conditions. My job is to pair us with the carrier that's going to give us the best rate because we meet their specific underwriting requirements, and every one of them is a little different. So we can get declined at Fidelity but approved at Foresters, or declined at Mutual of Omaha and approved at Transamerica, just based on what your specific background is. My job is to figure that out, and so that's what we're going to talk through today, so I can make sure we're being paired with the carrier that's going to hopefully get us an approval but also get us the best rate. But again, most of this is happening at the front end because we're setting the table, like Travis said in the comment. One, we're establishing ourselves as an expert. Two, we're undermining future objections. And then three, we're identifying, clarifying, and confirming the client's core motivation, right? So you had mentioned that you kind of did that at the front end of the call. They said they had gotten declined by Fidelity, and you said, okay, well, that means something's going to show up. And what it sounds to me like you were doing in that moment is you were actually trying to manage expectations to say that, well, Fidelity declined you, which means there's something in your medical records. So let's set our expectations properly, because that means it's probably going to show up elsewhere too. That's how I received that, based on how you just said it, which I'm sure you said it differently with the client on the phone.
Yeah. And it was that. And then it was, kind of the same thing. It's like each carrier is different. So what is it that is in your medical history that comes to mind? And it had something to do with heart medication. It had some heart medication that was triggering.
Yeah, probably metoprolol.
Yeah, because in all honesty, I think they had a stroke or a heart attack that they didn't want to disclose, something along those lines.
Buyers are liars, so that's
Yeah,
entirely reasonable.
so
So that now that's managing expectations, right? And if you skip the, identify, isolate, and confirm motivation piece of it, that's how you end up with the scenario where the client says, well, if I can't pay it off, I don't want to do it at all.
right,
Again, nothing works 100% of the time. Like we're not going to win 100 out of 100. Like we can't win them all. But if you're getting to the motivation, you're managing expectations, which it sounds like you did very well. And then you're also reframing at the front end on how these programs work and what you typically see. Like I'll usually say to clients, hey, there's three ways the programs work. They pay off, they pay down, they pay for. I'll say it all mostly depends on the family circumstances. So my job is to get to know you a little bit so I can kind of make some recommendations and guide you through this. Is it okay if I ask some questions, get to know you? And then we can, we'll talk a little further. Then you'll set expectations for the call and go. But in that, my job is to get to know you. As soon as I know who their beneficiary is, I want the home to go to the kids. I want to protect the spouse. I have a disabled dependent at home, or I've got a family that's a member that's a roommate or whatever it is. Once I hear if it's inheritance, I'm going to say, oh, okay, great. So you want to make sure that this is part of your legacy, that the family keeps this. I'm immediately positioning away from paying off the whole mortgage. So I'm saying, yeah, in most cases, families that are in, most families in your situation that are wanting to make sure the home goes to the kids or the family, whatever, most of them will just they'll choose the option that pays for the mortgage, primarily because number one, it keeps your budget down. And this is the time of life where you should be filling the photo album with photos and memories and stories and all of those things. The last thing you need is being insurance rich and cash poor. So most families will choose the one that pays for the mortgage. And aside from the budget, here's why. Most of the time, if there's multiple kids, one of those kids, if they want to move into the home, they're going to have to refinance it and buy the other kids out. So that means that they're replacing the mortgage shortly anyway. Two is if they're not planning on moving to the home, they're gonna sell it, And if it's multiple kids and they don't want to move into the home, they're going to sell it anyway and split the equity. And so I'll say now, your home today is worth 500,000. You owe 150 on it. That's 350,000 in equity. At 4% per year over the next 10 years, your home's going to be worth like 750, 800,000. So, that's a difference of, 650,000 that's going to go to the kids. That's a sizable gift. Now, is there any material difference between, 800,000 and having the mortgage paid off or the 650 in equity they're going to get anyway? Because you just want to make sure the home goes to the kids. Right now, if the kids get 650 instead of 800, that's still a pretty sizable gift, right? And then the clients see like, okay, yeah, the kids are going to get a lot out of this. And I can say, yeah. So the only difference between paying off the mortgage for the kids or just paying off versus paying for the mortgage is if you pay it off, the kids will get 800, but you're going to spend a good amount of cash in the process. If you have it pay for the mortgage, you'll keep your budget down and the kids are still going to get 650. It's still protected from the bank and they still have all the financial resources to do what they need to do with the home in order to secure that piece of your legacy that's setting them up on that financial foundation. Does that make so I will use that talk track as a way to get, if it's for inheritance, get them off of the pay off the mortgage. Most of what I'm doing at the front end of the call is getting the client to see that they don't have to pay off the mortgage. Okay, we got 3 minutes left. Other questions, comments, things that are coming up for you guys?
Yeah, I got a question. The pay for the mortgage that you just mentioned that you try to position people to,
Yeah.
Is that you're taking the monthly payment and you're going, hey, here's 6 to 12 months of pay? Like what is the pay for the mortgage exactly?
Yeah. So again, the way that I do it is a little more sophisticated because I do it based on the client frame or the client archetype. So if it's an inheritance frame, I'm usually framing it as 9 to 15 months. I'm never going to 6. 6 is more like if it's a final expense client, they just can't afford it, then I'll back into 6. But I'm usually framing it as 9 to 15 if it's inheritance. If it's spousal, I'm framing it as 18 to 30 because leading psychological guidance says a spouse shouldn't even have to think about a major life decision for at least a year post loss. Last thing we want is our loved ones dealing with a financial crisis and a housing crisis on top of the loss of the most important person in their life, right? So we want to give our spouse time. If it's care continuity, then I'm like 36 months, like 24 to 36 months, or pay the house off in its entirety, but make sure that that disabled dependent has plenty of time for whomever is going to be the caretaker to figure out how this is going to work. If they got to move, is there a care network and all those things to make sure that that person is taken care of. And if it's like a family member's living there, then usually I'm framing it as 18 to 24 months. So I'm never really going to 6. 6 just isn't a lot. And if you really think about that, it's like loss happens day one. By week 3 the client is having the service, so like you burn a month just in the service. Months 2 and 3 is like that's grieving and like, oh my god, what are we going to do? They got to start making mortgage payments 3 months after that. It takes at least a month or two for a family to go clear out a home, find a realtor, take the pictures, get it listed, and then it takes 4 months on average in the United States today to close on a home sale. Average time on market 74 to 90 days, and then it takes another 30 days to actually close on the mortgage. So it's like no matter what, even if they're moving super fast, 6 is real tight. So we're only ever going to 6 if we're like super budget constrained.
Got it. And the way you calculate that is the home payment times the amount of months of coverage.
Yeah, it's fully loaded. So you want to go mortgage payment, which is PITI. It's the principal and interest on the mortgage, and then taxes and insurance. And then you also want to load that if there's any HOA dues. And then there's several other ways to increase that coverage amount, i.e., home maintenance and preparation money that they'll have to put into the home to get it to sell. An emergency fund in case the water heater breaks in the middle of the night, so they have some money to fix that. Travel and moving to pay for movers, rent the U-Haul, the storage unit, etc. So there's other things you can add onto it.
Got it.
You got
What about
that's mortgage
do,
payment?
do you add the cost, like the service costs, like burial, cremation on top of that as well?
Depends on if they have it already or not. A lot of people will already have a final expense policy or something to that effect. And so then we're going to look at what are they paying as cost per thousand on that policy. If we can beat it, then we'll roll it in and replace it. And if not, we'll just leave that be. If they don't have anything at all, then yeah, we include that, like 3,500 to $5,000 for cremation, 12 to 15 for burial.
Got it. All right. Appreciate it.
Yeah. Okay. Thank you all. Shoot me a text, phone call, email, anything if you guys got any questions. And I'll see you on the boards. Take care, guys.
Later, Dustin.